The mother of all stagflation is upon us, according to Nouriel Roubini, the chief economist who predicted the 2007 through 2009 financial crisis. And he is back again stating that this recession will look a little bit different, that we're still going to have high elevated prices and at the same time high borrowing costs. When the pandemic first hit, the Fed, in response to the pandemic, started lowering interest rate and printing a ton of money. And with that drove up the economy to elevated heights that we never seen before. And now we have inflation because of what the Fed was doing. Now that the Fed is trying to fix their mistake, we as consumers have to pay for their mistakes through higher borrowing costs, right? By higher interest rates on our credit cards, on our car loans, on our mortgages. And right now we are still trying to slow down the economy, but at the same time, prices are not going as low as the Fed has anticipated. And at the same time, we have these higher interest costs. And so that's why we and a lot of economists are believing that we will enter into stagflation for most of next year. And so in today's video, we're going to discuss the different factors of stagflation and why stagflation is upon us and exactly how it will look in 2023, especially in the housing market, and how this could make the housing market crash even worse. What do you all think about stagflation? Do you think we will actually enter into stagflation or even hyperinflation? I made another video talking about hyperinflation. So if you're interested, please watch that video. But in that video, I talked about something beyond stagflation where we're in hyperinflation, where prices are just extremely high and, nothing is actually worth its value. So Apple can cost $1 million, but, they print so much money that the value of it is not actually $1 million. I don't really see that happening, but a stagflationary period is plausible. So please be sure to comment down below if you think a stagflationary period is upon us, and also be sure to like this video for support and subscribe to this channel if you want to see more content around real estate, the housing market, the economy, and just personal finance. Now, as I stated earlier, the Fed is trying to cool down the economy. They are trying to lower inflation. So right now, the Fed looks at the core PCE, and I made a video talking about, yes, CPI is important, but the Fed actually concentrate on this index called the Personal Consumption Index, or the PCE, specifically the core PCE that excludes food and energy costs. Right now, that rate is hovering around 5%, and Jerome Powell has been stated to wanting to bring this rate below 2%. But a lot of economists are saying that this is an impossibility, that it's almost impossible to come down to 2% inflation. Especially what happened recently with the pandemic. It may have much longer lasting effects than what the Fed anticipates. So with bringing inflation down, the Fed is hiking interest rate to make borrowing costs a little bit more expensive, which bring demand down and in turn lower prices. But right now we still have elevated prices across the economy, especially in the housing market. And that's the sector that we're really going to concentrate on, because the mortgage rates are heavily influenced by the Fed rate. And so there's usually a direct component to, if there's a higher Fed rate, we will have higher mortgage rate. If it's lower, then we will have lower mortgage rates. And so it's a good indicator to see how the economy is doing as it pertains to inflation. So how does stagflation currently looks in the housing market? Well, right now we still have elevated home prices. Home prices haven't gone down to the rate that the Fed actually wants it to go down. Yes, the amount of homes being sold have declined a great deal, but the median home price of properties are still pretty expensive. And then on top of that, we have higher mortgage costs. And so a lot of home buyers are hit with a double whammy. Number one, they probably can't qualify for a specific mortgage because they are out of range because of the higher interest rate. And then on top of that, we still have high prices. And so yes, demand for housing is down, but at the same time, supply is down. So this is confusing. That's why we're in a stagflationary period, because we have higher home prices and higher borrowing costs. Usually during a recession, you usually have the price of the home go much lower, like what happened in '08, home prices fell dramatically. But now we're having this weird period because of what happened with the pandemic and the Fed trying to fix their issue that initially falls upon us as consumers. And with that, people can't afford homes, but they're still expensive because people are not wanting to sell their homes because they still have in their mind that, okay, I could sell my house for this amount because my neighbor sold their house for that amount earlier during the year. But they're not understanding that the economy has shifted. And so a lot of home sellers are waiting it out. They're waiting until we get back to these high prices. They're going to sit on their house for 2-3 years until they actually get the price that they want for their homes. And this is not only in the housing market, this is across every other sector in the economy. For example, car prices. I've been getting into the car economy and just learning more about how manufacturers price their vehicles and the whole supply chain issues and just shortages of different components needed to build a car. And the thing is, just like home prices elevated during the pandemic, car prices has too. And a lot of manufacturers, since they're releasing their new models for 2023, they actually elevated their price much higher than the normal rate at which they increase their price year after year. So if you look at the company Ford, I recently got into just researching more about their pickup trucks and different things like that. And I noticed that their increase in their price is much higher than any other year within the past 20 years. Like some of their F-150 models have increased $5,000, $7,000, even close to $9,000 compared to last year. And their normal rate of increase is maybe between $1,000 to $2,000, which is normal for the next model year. But for some reason, this huge increase in price is brought upon them because of, yes, demand is lower. So what they're going to do, they're just going to make more expensive products to sell to few people. And so your average day Joe who's used to buying a Ford is no longer, they're priced out of buying a Ford because of supply chain issues, because of borrowing costs, because even Ford, they use the Fed rate to borrow money, and now they have employees to pay that they're laying off and whatnot. And so now you have this where a lot of companies and different individuals, they're seeing what's happening in the economy. And so they're doing things like that. They're increasing their price and they're either waiting out until someone buys it, or they're just selecting a few. They're decreasing their demographic or their audience to buy their product. And so that keeps prices high so they can earn a profit and show that they look good on the balance sheet. And at the same time, borrowing costs for these products are still high. Now, talking about stagflation, Bank of America did a survey with over 270 fund managers, and 92% expects stagflation for next year, where growth continues to slow while inflation remains above average. And so, yes, these fund managers believe that the economy will remain in an inflationary time, right? And most of these experts are saying, yes, 2% is impossible to get to, especially for next year. And so how is it going to look like for next year? The next thing I want to talk about are the indexes. So for example, looking at the PCE, as I stated before, it's around 5%. And so that 5% represents there's a 5% inflation or 5% increase compared to this time last year. And so for example, the month of November 2022, the PCE was around 5%. That is compared to November 2021. And they're just comparing the price. And so yes, there's still an increase, decreasing a little bit, but we still are well above normal rates of inflation. And why it's going to continue into next year is because the PCE and these inflation, what the prices were about a year ago, it doesn't really show the true reality right now. Yes, you can look month to month, but most of these percentages are based off of numbers. So let's jump into the future. November 2023, and the median home price is $400. Still relatively high, but the CPI, the PCE reports will show around a 2% inflation rate. And so home prices really didn't fall. Yes, the rate at inflation or the rate of growth did decrease, but inflation will still continue to increase year by year. And a lot of economists are predicting this scenario. And so $400,000 is pretty expensive for most people today. And next year it will be even more expensive because the Fed is just going to continue hiking their interest rate. And so the mortgage by this time next year may be close to 10%. Yes, the Fed may be celebrating. Yes, we got inflation down to 2%, but there's still a huge affordability issue that's threatening the economy. And the thing is, some economists are predicting home prices will fall a little bit next year, but other economists are not so sure about that. Different companies like Realtor or Zillow, they're on the fence. Some are saying, yes, it will increase. Some are saying it will decrease. My personal opinion is that it's not going to decrease by the amount where it becomes affordable for the average consumer. It may decrease, right? Like, for example, I made an offer on a house that's super overvalued. It's overpriced in my opinion. And I made a lowball offer and they went down. Yes, they did go down, but they probably went down around maybe 5% off of the original asking price. And we need home prices to go down way much further than 5% in order for us and the economy to be more affordable for most people. A top economic strategist stated that our best guess is that we're going to be in a period of stagflation for several months through maybe most of next year, referring to a toxic combination of stagnant economic growth and stubbornly high inflation. So what do you all think? Do you all think prices will remain elevated? Do you think prices will come down a little bit? Are you seeing any decreases in price across your buying habits? Maybe different food products you buy, energy costs such as gas or your electric bill, water bill, or do you see that with plane tickets or even if you're shopping for a house? Let me know down below. All right, make sure you all like this video, subscribe, comment down below, and I'll talk to you all later.